Good morning, everybody. This is Live Trading Talk with Patrick MontesDeOca. For January the 10th, 2022. As we enter into the second week of January 2022 here, it seems that interest rates are moving higher. We're taking a look at the 10-year note trading above 180 at 1808, up 2.2%. We've seen a fairly sharp rise in interest rates here in the last couple of weeks of 2022. With a low made in January of 2020 of 0.32% on the 10 yield, we are currently trading at 180, 181. And for all intents and purposes, if you take a look at the technical side of the market, it looks like we're putting in some kind of a major double bottom on interest rates on the 10-year note. Let's take a look at the 30-year. For the same time frame, the 30-year note is trading at 214. It's up 132. The lowest yield that we've seen on the 30-year note is 0.70 back on the same date, on January the 3rd of 2020. And we are challenging pretty much the highs that were made of 251, 252 during that period. One of the things that I'm noticing here, which is an inversion basically on the yield curve, which is the velocity of rates going up short term against the 30-year, and we use the 10-year note to take a look at that yield curve. And what we noticed here is that particularly in the last few weeks, the rates on the 10-year note have inverted and have moved higher faster than the 30-year note. And that's what we call an inversion in the yield curve. And that means basically that the cost of money on the 10-year note is going up faster than the 30-year. Somehow they are maintaining the rates on the 30-year lower than the 10-year. And the 10-year reflects basically the inflationary expectations that have developed here. We have a couple of economic indicators coming out. On Wednesday, the inflationary indicators are coming out. And we're going to be dealing with those fundamentals here as we move into the later part of this month, the second half of this month. Now, one of the things that I'm looking at basically is what's happening here, obviously, to the metals that we're trading, the gold, silver, and Bitcoin that we're trading. But I wanted to share with you basically what we're looking at in terms of the cost of money, which is basically the heart of everything that is done on Wall Street. Is, how much is it going to cost? What is the cost of money? What is the cost of borrowing? What is the cost of financing? Is free money being reduced, eliminated. The feds are tapering about $30 billion until March, and the question is basically how fast interest rates are going to go up. Now, we're dealing with an economic landscape that is very much different than the 70s, which we are comparing this inflationary levels to. But there's a big difference here, and this is, I believe, the major dichotomy that needs to be resolved here in identifying interest rates, basically having the ability to go up, to move up aggressively. Now, the economic numbers seem to indicate on one surface that basically we're running into a strong economy. Demand is obviously supposedly very, very strong at record levels, but when you take a look at the yield curve, and in particular with this Omicron infections, although it seems to be possibly the ending of this pandemic, it's nevertheless reaching record levels in hospitalizations as a consequence of it. And obviously, the thing that I'm looking at is how much of that is going to reflect on the economy. And so we're dealing with the possibility of a slowdown in the economy. People are pulling back. They're not going into restaurants. I mean, everything is being restricted. Vaccinated required, and resistance against vaccination. It's becoming a political issue. Nevertheless, the end result, I believe, that will take place will be that we will have an economic impact. And so it's very difficult to take a look at this environment that is completely inverted, or the market is inverted to the fundamentals, when you're looking at the possibility, again, of a shortage of supplies. A bottleneck of supplies continues, and we're dealing with the possibility that as a consequence of the high levels that we're dealing with regards to prices, inflation, people are going to be pulling back. And that is not obviously very healthy for the economy, for the demand factor. We're looking at crude oil trading at $80 a barrel, and it's 80.85, and that's not a relief to the economy. It's a tax on the economy on top of it, and so I think what potentially could happen here with regards to interest rates is a very similar situation that we had the first time the Feds raised interest rates back in 2015, 2016. That was the first time, and that was the bottom of the gold market. And so if they do raise a quarter point, I think there's a very good possibility that we could see the gold market pretty much respond in the same way that it did back in 2016, 2017, when basically it was the bottom of the gold market. And the market pretty much rallied into that increase of interest rates. But then the Feds decided, basically, as a result of the markets having a fit, a tantrum, so to speak, decided to reduce, again, interest rates. And reverted, basically, and that's when we began to see rates move down aggressively to the negative rates that we are dealing with right now. And pretty much that particularly for the gold market. It made a bottom here on April 19th, April 22nd of 2019, about 1267, and it rallied, from there into basically about 1704, about $500 prior to the pandemic, which collapsed the market from that 1704 level that it was trading at all the way down to 1450 again. Now, mind you that this was a short-lived situation here, that they broke the market down from March the 9th of 20, obviously, due to the pandemic, and the low was made by the 16th at 1450.90. From there, again, we rallied another $600 all the way up to 2019. So when you really take a look at the gold market from 2019, $1,267, all the way up to the high that we made on 2020, it moved a spectacular move, from 1267 to 2089. And obviously, after the high was made, which was an aggressive move in anticipation of the Feds beginning to print unlimited amounts of money. And at this point here, the Feds anticipated that they were looking at about a 10%. They had allocated about 10% of the GDP for this crisis. And the market discounted this. And so what we've seen here since August of 2020, the market made a high of 2089, and it inverted all the way to a low that was made at 1673 on March the 8th of 2021. And this level here essentially was a Fibonacci retracement of the golden ratio retracement of 61.8% from the low that was made on March the 20th. So the gold market is following a very strong technical picture, and it's adhering to its Fibonacci sequences, to its Fibonacci retracements. If we take a look at the closer picture from the low that we made in March of 2021, 1673 was this bottom that was made, which was a perfect Fibonacci 61.8% correction, and rallied all the way up to May 24, 2021. Now, what this rally did is establish the resistance level for a major uptrend that has developed. And upon confirming the uptrend, the market reverted to test the levels of support and came down again, as you can see, to a low of 1677. And finally, on September 27, 28, the seasonal low was made. The cyclical low was made at 1721. Now, you're taking a look at the annual low, obviously, of 1677. The cyclical low was 1721, and this is the low that we use for our calculations. And from this low here, we're looking at the market here trading, obviously, you can see clearly within this major uptrend channel, establishing support by coming down and testing it again around December 13th, and then we basically are in the process of reverting from these levels that indicate the market could rally up to the upper end of this extension of this uptrend line channel of over $2,000. Now we're taking a look at the weekly numbers here. On the left of the chart, you're looking at the weekly numbers. And on the right of the chart, you're looking at the daily numbers. I want to add Bollinger Bands here. Just to compare where we are in relation to Bollinger Bands. And what you see here is that the price trading between the weekly average and the daily average is neutral basically, but the daily average is in a bullish price momentum within a bearish weekly price momentum. And so we're pretty much watching the market build and trade around the average. And we, in particular, I do not trade around the average. I don't recommend my traders to trade around the average. It's pretty choppy. So we watch what the action short term is going to define. And we use those levels, basically the most highest probability levels, to identify a trade. So you're taking a look at here at the market trading around the average daily, below the average, but right below it you're looking at 1796, which is, 1786, which is the buy one level daily. The pivot point that is telling us that this is a level of support, this is where we want to identify the highest probability. The algorithm gives this pivot point a 90% probability of a reversion back up to the mean if we activate this. The average price, daily or weekly, is a 50-50 standard deviation. So it could go either way. And we wait for the highest probabilities, and that is for the price either to go above the average into the resistance levels in red, which on a weekly identify 1826 to 1855 for the rest of this week. These are the levels that we'll be looking to take profits on the swing or position trades that we have. If we come down into the blue levels of 1786 to 1777 on the daily, we might look at a day trade signal. If we come down to 1774 to 1752, these are levels where we are prepared to add to our long position or to get on the long side. take a look at the other markets here. It's a quiet morning here for the metals. Crude oil trading at 78.23. A little bit of profit taken here. Bitcoin is in a reversion mode from 39,470 low that was made. This is what you call a reversion unfolding when we get supply like this to come into the market, into this level of blue. This is what is expected. And it did not quite come down to the weekly by one level of 38,943 as the low of 39,470 was made, and it found buyers here. This is what we identify as the reversion to the mean, basically, where we have buyers that are stronger than the supply that comes into the market. They take out all the supply and the market moves up, and it's reflected in the price. 39,470 is the low, trading last at 46.10. So as the market finds buyers, basically, because what we're teaching here and what we're sharing with you here is the basic denominator that essentially you need to understand about day trading, particularly day trading. It's all about the exchange of the supply and demand. It's all about the difference between a bullish psychology and a bearish psychology. When you're day trading, it's all about technicals. The fundamentals are pretty much buried into the long-term picture of the market that, in this case, if you compare the fundamentals, they're completely inverted to the market. So we're looking for opportunities as we see that the price of Bitcoin, gold, silver have come down to blue levels. And so far, this level of 40,000 on Bitcoin seems to be offering, again, tremendous value, tremendous support. And what we're looking at is buyers coming into on these corrections, coming into the market and accumulating. That is what the algorithm identifies when the price is in blue. It tells you you're looking at a very high probability to accumulate. It's been a quiet morning here, not many signals that are active here. Markets are trading around the mean, the average price. As you can see here, it's silver. It's trading in the same range between the weekly average of 22.59 and the daily average of 22.26, activating a bullish price momentum daily within a bearish price momentum. So it's a little bit of a confusing pattern because it is trading around the average 50-50 standard deviation. We're back on silver, 22.40 here, and we are holding a swing position in silver that we recommended last week to all of our subscribers here. We are holding a March 22 long position here that we bought from 2202. You can trail the position with a stop if you have a profit built in, until the objective, you might say, is completed here. But continue to hold on to this position and continue to hold on to your core position in the metals here. Our time is coming real soon, my friends. So in the meantime, please be careful. Take care. Have a great trading day. Have a great trading week. I'll talk to you next time.